Imagine this. You're building a house. You wouldn't just use bricks, right? You'd need cement, wood, maybe some steel. Investing is similar. You need different pieces for a strong portfolio. Bonds are like the cement in your investment mix. They provide stability and strength. Stocks can be exciting, but they're also like roller coasters. Bonds, on the other hand, are more like a calm lake. They offer a smoother ride, especially when the stock market gets bumpy. Why are bonds so important? They help protect your money. They can even generate income for you. Let's dive in and learn more. Think of a bond like an IOU. You lend money to a company or the government. They promise to pay you back with interest. It's that simple. Let's break it down further. You're the lender, also known as the bondholder. The borrower is the issuer of the bond. When you buy a bond, you're essentially giving a loan. In return, the issuer promises to make regular interest payments. They also promise to return your original investment on a specific date, called the maturity date. Just like there are different types of houses, each designed to meet specific needs and preferences, there are different types of bonds in the financial world, each serving different investment goals and risk appetites. Each type of bond has unique features, benefits, and levels of risk, making them suitable for different kinds of investors. First up, we have government bonds, often referred to as treasury bonds or T-bonds. These bonds are issued by the United States Treasury and are backed by the full faith and credit of the U.S. government. They are considered very safe investments because the government is highly unlikely to default on its debt obligations. This makes them a popular choice for conservative investors looking for stability and security. Next, we have corporate bonds, which are issued by companies to raise capital for various business activities such as expansion, research, and development. These bonds typically offer higher interest rates compared to government bonds, reflecting the higher risk associated with them. The higher interest rates are meant to compensate investors for the increased risk, as companies can face financial difficulties or even go bankrupt. If a company goes bankrupt, bondholders may lose part or all of their investment, making corporate bonds a riskier option compared to government bonds. Finally, we have municipal bonds, also known as munis, which are issued by state and local governments to fund public projects like schools, highways, and hospitals. These bonds often offer tax advantages, such as being exempt from federal income tax and sometimes state and local taxes as well, which can be very appealing to investors in higher tax brackets. The tax benefits can significantly enhance the overall return on investment, making municipal bonds an attractive option for those looking to minimize their tax liability while earning a steady income. In summary, understanding the different types of bonds and their unique characteristics can help investors make informed decisions that align with their financial goals and risk tolerance. Whether you prioritize safety, higher returns, or tax advantages, there's a bond type that can meet your needs. Diversifying your investment portfolio with a mix of government, corporate, and municipal bonds can provide a balanced approach to achieving financial stability and growth. By carefully selecting the right bonds, you can build a robust investment strategy that supports your long-term financial success. Here's where things get interesting. Bond prices and interest rates have an inverse relationship. They move in opposite directions. When interest rates rise, the prices of existing bonds fall. Why? Because investors can buy new bonds with higher interest rates. Conversely, when interest rates fall, the prices of existing bonds rise. This is because investors are willing to pay a premium for bonds offering higher interest rates than those currently available. It's like a dance. Understanding this relationship is key to making informed bond investment decisions. Why would you invest in bonds? Let's explore the advantages. First and foremost, bonds provide a steady stream of income. Remember those regular interest payments? They can act like a paycheck, especially for retirees. Second, bonds are generally less volatile than stocks. They offer a smoother ride, which can be very appealing to risk-averse investors. Third, bonds can help diversify your portfolio. By spreading your investments across different asset classes, you can reduce your overall risk. Section 6. Navigating the risks factors that can impact bond returns. While bonds are generally considered safer than stocks, they still come with risks. It's important to understand these risks to make informed investment decisions. One major risk is interest rate risk. This occurs when the interest rates in the broader economy change. As we discussed earlier, when interest rates rise, bond prices fall. This inverse relationship can affect the value of your bond portfolio. This can be a problem if you need to sell your bonds before maturity. If you sell when prices are low, you could incur a loss. Another risk is credit risk. This is the risk that the bond issuer will default on its debt. If the issuer defaults, they may be unable to make interest or principal payments, which can result in significant losses for bondholders. Finally, inflation can also impact bond returns. Inflation reduces the purchasing power of money over time. Inflation erodes the purchasing power of your money over time, meaning your bond investments might not be worth as much in the future. This is particularly important for long-term bonds, where the effects of inflation can be more pronounced. To mitigate these risks, investors often diversify their bond portfolios. Diversification can help spread risk across different types of bonds and issuers. Another strategy is to use a bond ladder, which involves holding bonds with different maturities. This can help manage interest rate risk and provide a steady stream of income. Investing in high-quality investment-grade bonds can also reduce credit risk. These bonds are issued by entities with strong credit ratings, making them less likely to default. To combat inflation risk, some investors turn to inflation-protected securities, such as Treasury Inflation-Protected Securities, TIPS. These bonds adjust their principal value based on inflation, helping to preserve purchasing power. Regularly reviewing your bond portfolio and consulting with a financial advisor can also help you navigate these risks. Staying informed and proactive is key to successful bond investing. Ultimately, understanding and managing the factors that can impact bond returns is crucial for achieving your long-term financial goals. By being aware of these risks and taking steps to mitigate them, you can make more informed investment decisions and build a more resilient portfolio. Section 7. Building a balanced portfolio, incorporating bonds wisely. So, how do you incorporate bonds into your investment portfolio? Bonds can be a crucial component of a well-rounded investment strategy, providing stability and income. They act as a counterbalance to the more volatile stocks, helping to smooth out the overall performance of your portfolio. It depends on your individual circumstances, such as your age, risk tolerance, and financial goals. Younger investors, for instance, might have a higher risk tolerance and a longer time horizon, allowing them to invest more heavily in stocks. However, bonds can still play a role in reducing overall portfolio risk. If you're younger and have a longer time horizon, you might choose to allocate a smaller portion of your portfolio to bonds. This is because you have more time to recover from potential losses in the stock market, and you can afford to take on more risk for potentially higher returns. This is because you have more time to recover from potential losses. Over the long term, stocks have historically outperformed bonds, but they also come with higher volatility. By including some bonds, you can mitigate this volatility and provide a cushion during market downturns. On the other hand, if you're closer to retirement, you might choose to allocate a larger portion of your portfolio to bonds. As you approach retirement, preserving your capital becomes more important than seeking high returns. Bonds can provide a steady income stream and reduce the risk of significant losses. This is because you need to preserve your capital and generate income. Remember, diversification is key. A diversified portfolio can help manage risk and improve returns over time. By spreading your investments across different asset classes, you can protect yourself from the poor performance of any single investment. Don't put all your eggs in one basket. Diversification means including a mix of stocks, bonds, and other asset classes in your portfolio. This approach can help you achieve a more stable and consistent performance regardless of market conditions. A well-diversified portfolio should include a mix of stocks, bonds, and other asset classes. By carefully considering your individual circumstances and investment goals, you can create a balanced portfolio that meets your needs and helps you achieve your financial objectives. Section 8. Beyond the Basics, Additional Resources for Bond Investors. Ready to delve deeper into the world of bonds? There are plenty of resources available to help you become a more informed investor. You can find a wealth of information online from reputable financial websites. These websites often provide educational articles, bond calculators, and market data. Consider consulting with a financial advisor. These professionals can help you create a personalized investment plan that meets your specific needs and goals. Remember, knowledge is power. The more you learn about bonds, the better equipped you'll be to make informed investment decisions. Section 9. Your Journey to Financial Wellness. Taking the Next Steps. Congratulations, you've taken a significant step toward mastering bonds and investing wisely. Remember, investing is a journey, not a destination. Continue to educate yourself and seek guidance when needed. Start small and gradually increase your investment amounts as you become more comfortable. Investing in bonds can be a smart way to build a solid financial future. By understanding the basics, you can make informed decisions and achieve your financial goals.